Every second, billions of dollars cross borders. When a country spends more abroad than it earns, an invisible safety net activates. Depending on the financial system, this net could be private global investors or the national central bank vault.
Think of the balance of payments as a giant national ledger. However, it does not strictly track cash flows. Instead, it records the change of economic ownership between a country and the rest of the world. This means transactions such as in-kind foreign aid or barter are securely logged, even if no physical currency ever crosses the border. Under standard International Monetary Fund rules, this ledger is officially divided into 3 main accounts. The current account handles everyday trade, including produced assets like heavy machinery, alongside primary and secondary income. The capital account manages capital transfers and strictly non-produced, non-financial assets, such as land for embassies or intangible rights. Finally, the financial account deals with foreign investments, borrowing, and changes in official reserves.
While floating economies rely heavily on private capital to finance deficits, nations with fixed or managed exchange rates depend on a different shock absorber: official central bank reserves. These are massive stockpiles of foreign assets and gold. Rather than just defending the exchange rate, central banks also use these reserves to service foreign debt, maintain liquidity for international trade, and provide a general buffer against severe economic shocks.
When a country faces a deficit, the gap must be closed. In a purely floating exchange rate system, private capital inflows typically finance the shortfall. If private funds dry up, the central bank does not have to intervene. Instead, the currency naturally depreciates, making exports cheaper and correcting the imbalance. However, if a nation is defending a fixed or managed exchange rate, the central bank must step in and draw down its own sovereign reserves.
Let us look at how an intervention works in a managed regime. A sudden crisis forces massive energy imports, widening the trade deficit. As a result, the local currency faces severe downward pressure. To prevent a crash, the central bank intervenes, selling off billions in foreign reserves to buy its own currency and restore stability.
In national accounting, this precise intervention is recorded as the change in official central bank reserves. Tracking this metric provides a definitive pulse check on a nation's financial sovereignty and its capacity to weather global economic storms.